Canada's housing market is unraveling and the numbers don't lie. Prices are projected to plunge another 3.5% next year, and the chill is spreading fast, but not everywhere. Because in the heart of the nation, Ottawa is breaking every rule possible. No crash, no slowdown. That's catching everyone off guard. This might just be the most underrated housing story of 2026. My name is Liam Swords. I make videos about living in Ottawa. I'm also a top producing realtor helping people just like you make Ottawa your home. In this video, I'm going to break down for you the 3 key things. Number 1, why Canada's housing market is stalling out. Number 2, why Ottawa is defying the trend. And number 3, how to position yourself to win in this shifting market. Stick around because Ottawa's townhomes are extremely red hot. Condos are wobbling, and a major rate cut from the Bank of Canada recently just changed the game. Let's start with the big picture. According to RBC's National Housing Forecast, you'll see here, Canada is on track for 467,100 existing home resale in 2025. That's roughly a 3.5% drop from last year. And here's the kicker. About 4.1% of that decline has already happened in 2025. So yes, the national market is slowing faster than expected. On pricing, RBC projects a 0.7% increase in 2025, followed by a 0.7% dip in 2026, with Ontario and BC seeing the most pressure as inventory builds and buyers regain leverage and confidence. Now, what's driving all of this? Well, big thing, trade uncertainty with the US is denting consumer confidence. Job insecurity is creeping into the workforce, especially in tech and construction. Immigration growth is cooling slightly after record highs, easing demand pressure. Put it all together, fewer bidding wars, longer days on market, and more cautious buyers across the country, from Newfoundland right to Victoria. And here's a new twist. On October 29th, the Bank of Canada cut its overnight lending rate by 0.25%, bringing it down to 2.25%. This is the third cut of 2025, and it's a clear signal the bank knows the economy is slowing and wants to stabilize conditions heading into the winter month. For housing, this means lower borrowing costs, easier mortgage qualifications, and a bit of breathing room for anyone carrying a variable rate mortgage. It may not flip the market overnight, but it changes buyer psychology just as we head into the quietest months of the year. Expect a modest late fall bump in showings and pre-approvals as buyers start peaking back before the spring market starts. Here's where it gets real and interesting though, folks. Ottawa doesn't behave like Toronto or Vancouver. Our economy is anchored by government, tech, healthcare, and education, stable sectors that cushion us from the volatility. The stability is exactly why Ottawa is outperforming national averages right now. Let's look at September 2025 data from the Ottawa Real Estate Board. Sales at 1,089 homes sold in September, down from 1,236 in August and 1,300 in July. That softening is seasonal and nothing to be worried about. Year-to-date sales are still tracking about 3% higher than 2024. Prices, well, the average price came in at $690,397, right between August's $386,000 and July's $695,000, up 0.3% year over year. So prices are holding steady even as volume eases. Benchmark prices stable across the categories, confirming demand is still there, just more selective. So that's Ottawa's story right now. Stability while most of the country is sliding. Now let's talk inventory, because that's where the balance really shows up. In September, active listings rose to 4,388, up from 3,971 in August and 4,205 in July. That's elevated compared to the past few years, but perfectly normal by long-term standards. The months of inventory right now sits at 4 months, which means Ottawa is in a balanced market. The sale to new listing ratio continues to hover around that low 50s. So now this isn't a flood. This is Ottawa transitioning from undersupply to a healthy equilibrium. something most Canadian cities would love to have right now. Ottawa isn't one story, it's really three micro markets. Let me break it down for you. Number one, we have single family homes. The benchmark right now sits at $774,800. This is up roughly 2% year over year, steady and balanced, with move up buyers still quite active in this segment. The second is townhomes, the standout performer. This is like the banner year for townhomes. Year over year prices are up 8% with strong demand from families, downsizers, and first-time home buyers. This is Ottawa's sweet spot segment. Then we have condos, the laggard. Benchmark prices down 2% year over year. The average price point for a condo right now is $411,000. Buyers are trading up for space and avoiding rising condo fees and lack of control that comes with owning a condominium. So again, Ottawa isn't the market. It's three distinct stories, and your strategy has to match the one that you're looking for, whether you're buying or whether you're selling or whether you are an investor. So why is Ottawa holding up while national markets stumble? Well, stable employment base. Federal tech jobs cushion that volatility. Number two, relative affordability. You can still buy here for 30 to 40% less than Vancouver or Toronto. Number three, balanced inventory. No panic, no frenzy, just choice. And number four, townhome demand. The middle market sweet spot driving appreciation. As I said, 8% year over year. Ottawa isn't booming by any stretch. It's balanced, and that's a very healthy place to be. It's the way real estate should be sold. Now, here's my strategy for you as a buyer, a seller, or an investor. For buyer, be patient. Inventory is up, rates are easing. As shared, Bank of Canada has cut the rate and now it's down to 2.25%. Slightly improve your qualification window, so update your pre-approval now. If you're targeting a townhome, expect competition. That's where demand is hottest. Sellers, price smart, not high. Homes listed realistically and based upon sold data will move and they will sell well. If you're selling a condo, manage expectation. The market is softer right now and days on market is significantly longer than it used to be. If you're an investor, avoid oversupplied condo towers. Focus on family-friendly suburbs, Barrhaven, Canada, Stittsville, Orleans, where the tenant demand and resale stability remain strong. And watch how first-time buyers behave. Roughly 75% now rely on family down payment help, which keeps the mid-price market busy. Think about it. How can someone realistically buy a home today? Much different than it was like 30 years ago. You got to come up with 20% down on a $750,000 house. That's $150,000 cash. Now, there are government incentives that we go through in other videos, but that's a lot of cash. As I said, 75% of first-time home buyers now are using family money to help them buy in and get into the market. Now let's zoom out and compare. Nationally, resale prices are down 3.5% in 2025. Ottawa is up 3% year to date. National average prices are flat, whereas Ottawa is up 0.3% year over year. So it's steady. National inventory, it's swelling. Whereas Ottawa, we're in a balanced market with 4 months of active inventory. And now with the recent Bank of Canada rate cut at 2.25%, borrowing just got a little bit easier as we head into the winter market. That could spark a small late fall rally as buyers re-engage before the year end. So while Canada cools, Ottawa is balancing, not crashing and not soaring, just moving on solid ground. And that's an opportunity if you know how to play it right. But there is one segment you should keep your eye on, and that's condos. Are we seeing an early sign of a correction in the Ottawa condo market? Well, if you want to find out, check out my next video right here, where I'll break down the numbers, the risk, and the opportunities in Ottawa's condo sector. I'll see you there.